You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for what the cool kids are calling OPR, what we used to call Options Playbook Radio around here, the program where we break down all of the fun maneuvers you can use in your portfolio. Maybe you want to play a little offense. Maybe you want to go on the income hunt, speculate a little bit. Maybe you want to play a little defense. I wouldn't blame you right now. Things are a little topsy-turvy out there. Either way, we got you covered. My name is Mark Longo from TheOptionsInsider.com, as well as from the Options Insider Radio Network. It's been blowing up. OPR, every show we're doing these days, you guys are sucking it down. We love that you guys are listening. Keep those reviews, keep those comments coming on all the platforms. You'll see a bunch of them here on this show in a few minutes. You guys are really enjoying the programs on an ever-expanding array of outlets. We're glad to see it. If for some reason there's an outlet that is not on, let us know. You really want to get it on some bizarre podcast outlet over there in the hinterlands of Argentina. We'll see what we can make happen. Either way, keep those comments coming, and of course, keep those reviews coming. Keep new people discovering a program like OPR, particularly right now. It's a very important time. People have a quality, reliable source of education and information about options. Keep those reviews coming in your platform of choice. To keep the new people, the new earlobes, discovering Brian and his good works here. Speaking of Brian, let's introduce your regular host every week here, Mr. Brian Overby, a.k.a. the Options Guy over there at Ally Invest. Mr. Overby, welcome back to your own program, sir.
It's great to be back, Mark. And as always, I love it when we get a chance to huddle up. I wish that we could do a huddle up every week, honestly, because I think I enjoy answering the listener questions more than anything that I can talk about on Options Playbook Radio. So let's get together and huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, like the man said, let's get to it and huddle up, see how many of you we can squeeze onto the show. Let's kick things off, Brian. These are kind of tumultuous times that we're in. Let's kick things off with some love. Let's go out to iTunes for this. This is a 5-star review coming from Boatlog. Boatlog says, great podcast. Perfect length, 15 to 20 minutes. If you want to learn about all the basics of options trading and all the things to watch out for when trading any strategy, this is the podcast for you. Well, thank you, Boatlog. All of you out there who keep those reviews coming in those platforms, that helps new people continue to discover the program. Like I said, these are more important than ever right now. So, Brian, what do you say to a little bit of love from someone who's clearly a fellow mariner out there, Mr. Boatlog?
Right. He's going to have a busy weekend, right? Going over the 4th of July. And it's good to see him out on the lake. That's a good way to social distance overall. So I hope he gets that chance to go on out and enjoy the holiday. I was actually kind of thinking too, Mark, this is great to get this type of feedback, but maybe the huddle up, that's a little bit scary in this unprecedented time. Maybe we should say huddle up with social distancing. Right? We got to be 6 feet away overall.
We'll put that in the show notes. We are doing this virtually, listeners. So Brian and I, unfortunately, not in the same studio.
It's a virtual huddle.
It is indeed. It'd be cool to huddle up with Mr. Wyatt, though. He's been a fun guest star on the show.
Yeah, so Wyatt's my son. He's been making some guest appearances here recently. So a lot good, clean fun overall.
All right, let's keep the fun party rolling here. Next up, this is a question from Brian for Brian. Brian, you're asking yourselves questions here. Obviously, it is another Brian here. He says, he even comments that. He says, great name. He says, quick question. Even though the market is closed on Friday, do weekly equity options still expire on Friday or on Thursday night instead? Thanks. Well, he's obviously referring to the holiday we have coming up here. July 4th holiday, usually a long weekend on the Monday side this week because it falls on a Saturday. We're getting Friday off, so no shows on our network this week, so no Friday in terms of Friday, so no vol views this week, listeners. Unfortunately, we apologize in advance. Don't blame us. Blame the markets. Blame the holidays out there. But if you notice, Brian, if you look at your options chain for a lot of the weeklies expiring this week, they'll kind of give you a clue. They will say the July 2nd weeklies as opposed to July 3rd. That should give you some clue. If you still are confused about this is where I've been sending a lot of people of late. It's the place to go. Really, if you have any question about contract specs, anything along these lines, it's OCC. That's the place to go. That's the Options Clearing Corp. They have their expiration calendar. Why should you go there? Well, because they're the ones who are the source of record. They handle the expiration and the contract settlements and all that good stuff. So that's going straight to the horse's mouth. And if you look at their calendar, they also show that Friday is a holiday and the second is expiration. In fact, if you scroll down to the bottom of their calendar, they even have a little standard disclaimer that say weekly product expirations occur on Mondays, Wednesdays, and Fridays. Any standard weekly, monthly, or quarterly expiration that occurs on an OCC holiday will be moved to the preceding OCC business day. So that all lines up there, Brian, for the second. The other Brian, a.k.a. the host of the show, do you have anything to add for your namesake here, sir?
No, that's pretty straightforward. And the options expiration calendar, I make sure at the end of every year to go on and print that off, and I keep that right on my desk. It's a great resource, and I love the fact that they produce it just overall. And it reminds me every once in a while that I get a market holiday. I usually get a Monday off every once in a while, so that also kind of helps me with that overall.
Yeah, we love a little bit of holidays here or there just to give us a little bit of a break here on the network. We love cranking out the content. We're glad you guys are sucking it all down like crazy these days. But a little bit of a break isn't the worst thing out there. All right, next up, Brian, get ready for some more love coming your way. This comes from Pradeep. Pradeep, he says, Brian, love in all caps, love your Options Playbook Radio podcast. I always find myself eagerly awaiting the next podcast. You, all caps again, you are always to the point, no fluff. You summarize the play for us at the end, and I stand educated after. Thank you. Again in all caps, Brian. This guy's feeling the love. I have a question. How do I stop loss or limit stop from a vertical spread that I may have sold? And he puts in parentheses, and iron condors, so adding a little wrinkle there. Can you please describe or point me in a direction? I appreciate your help. Thank you again, Pradeep. Well, there you go, Brian. This is just a love fest for you here on the show today. What do you have to say for Pradeep? A, in his all caps love for you on the show, and then B, to his questions about putting in stop losses on verticals and iron condors, sir.
Yes, I think my mother did a great job of picking out the questions this week.
Good old Pradeep Overby. I knew she was a big fan of the show.
So if I look at this, stop losses. I guess I'll jump right into it. You can do a stop loss. Now, the downside of option trading is even in the stock world, stop losses just aren't always the best way to go overall, in that just fills on them can be poor from time to time. But it is possible to do a stop loss, and we'll just talk about a short spread. Pradeep also mentions iron condors, but just think about a short vertical, and I want to protect myself against the downside. How would I do this? Now, there are two ways that I can do it. I can do it based off of the stock price, but if I do it based off of the stock price and say, okay, I want to enter an order, it would be an advanced order, and your brokerage firm would have to support that. Not every brokerage firm does, but it would be an advanced order saying that if the stock gets to this price, let's close out this spread. I'm going to buy to close the short option, and I'm going to sell to close the long option. So the downside of that is that you're going to be putting in an order to do this, and it's going to be probably at the market. So there's no way to predict what the prices would be based off of the price of the stock, and no way to predict what the bid-ask spreads, the width of the bid-ask spreads would be. So I say lay down until the urge goes away as far as that's concerned. I'd rather just set myself an alert on the stock and then go look at the spread and then see if I want to get out at that price or not. Now, the second form makes a little bit more sense. If you do have access to some advanced orders, a lot of times you can say, well, I want to base the stop off the price of the spread. And specifically, some brokerage firms will allow you to do it off the midpoint. Now, the downside about the midpoint is there's no guarantee that you're going to get a fill if you place a limit order. So let's say I sold a credit spread for 50 cents. The market's going against me. It's now trading for $1. It's going to cost me $1 to get out. I'm going to be down 50 cents on that trade if I get out right now. I can say I want to buy to close at a limit price of $1, but when do I trigger it? And the way that I would try to work that trade is that if I'm trying to close it at $1, I want to trigger it when the midpoint gets to about 95 cents, right? So I want it to not miss my midpoint fill. And I'm going to emphasize this only really works if you're trading real liquid option contracts. Just because bid-ask spreads are so tough, in general, you should be trading more liquid option contracts. And I know you talk about that a lot on your show too, on your shows here on the Options Insider, Mark. But in general, most people will trade options and a little bit more liquid underlying. But if I'm doing this trade and the market comes down, I got to think about where do I want the order to trigger? That's going to be the stop price. And where might I get a fill at? Because you're just guessing overall. But this is the only real mechanism that you have to try to get out of a short spread, either on the call side or on the put side, other than just setting an alert on the stock gets to a certain level, and then going in and physically entering your order based off of the stock price as opposed to the option credit spread price.
All right, well said there, sir. Let's see. We can squeeze in a few more. People like that condensed time frame, so I don't want to run on them. But I know you guys send in a lot of questions, too. I'll make sure we squeeze in as many of you as we can. Well, here's a comment here from Akmomo. Akmomo chiming in on something we were talking about on the show back a month or two ago. This is back in the hubbub, the kerfuffle around negative crude oil and all the impact that was having on products like USO. He touched on this program as well as many others on the network at that time. He chimed in and says, great show. Well, thank you, Akmomo. I enjoy it a lot. Well, we enjoy that you listen. Keep it up. He goes on to say, I agree that USO now has a larger futures window. He puts in parentheses WTI and crude, which is a good thing. Plus, according to their prospectus, they can invest in many instruments. Yeah, we talked about that on the program back when all this was happening. We touched on it a few times since. USO, a very different beast now than it was pre-negative crude oil. At that time, USO was predominantly in that front month WTI contract, listeners, and that's a good thing if you wanted to closely track the price of crude oil. The downside is it's exposed to all sorts of madness, like when that front contract goes negative. Now, when you spread it out, you're much more insulated from that, and much more rational prices can usually be found in the longer-term portions of the futures curve, whereas very up close, very near-term, anything could happen, as we saw out there. So the upside of that is that it's got a better chance of surviving any sort of future shocks to the system. The downside is it doesn't track crude oil quite as one-to-one anymore. So that's what you're into USO for. maybe other products will serve you better. But I agree with you in general. It is a good thing for the long-term health of this product to not put all of your eggs in the literal front month basket here. Let's keep on rolling because we want to squeeze other people in really quickly. Here's a fun one, Brian. This comes from Amy. Amy Charing. She says, folks like Nassim Taleb and others seem to prefer selling ratio put spreads to simply buying puts to hedge long equities against catastrophic meltdowns. Are you in favor of that approach? Is there an optimal construction in terms of months, percent out of the money, and ratio of short to long puts? Thank you for your time. I look forward to this program each week. Well, we look forward to you listening there, Amy, and everyone else out there. This is kind of funny, Brian. I remember when we first discovered this years ago on our Volatility Views program, we were all kind of taken aback because Taleb, what's he famous for? He's famous for the Black Swan and telling everyone out there to hedge against the Black Swan, hedge against the Black Swan. And so you'd think a guy like that would be loaded up to the gills on as many out-of-the-money puts as he possibly can. And he doesn't take that approach. He actually sells narrower-term out-of-the-money puts to buy more on a ratio farther out-of-the-money puts. So in net, he's long units, but it's an interesting approach to doing it. I'm curious, Brian, if you've seen this, if you have any thoughts on taking this approach versus just loading up to the gills, which I think is the misperception a lot of people have when they first come away from his book. They have to go hedge like crazy right now. There are sane and sensible ways to do it. And then B, if you have any thoughts in general, Brian, on maybe selling ratio put spreads versus just selling puts out there in the S&P or wherever else you want to do it.
Yes. Well, first of all, who am I to critique Mr. Taleb? If he's saying that this is the way to do it, I think I would agree. He's had a proven track record, that's for sure, overall. But with that said, I have talked about ratio put spreads as an alternative to just buying a put outright. And it's quite simple. Like Amy in the question here talks about the number of longs versus shorts. Normally, I'm just selling one short or one closer to the money strike option contract, a more expensive option contract, to try to pay for two out of the money option contracts. Now, this is what's tough in the option trading world, because how would you like to construct them? Well, there's no golden book of answers on a general basis overall. You really need to focus on what underlying you're talking about in order to come up with that construction. That would be worth mentioning, because I'm going to do it differently in the SPYs, for example, than I'm going to do it in just Apple or in Walmart. All of these are going to be constructed a little bit differently because of where the implied volatilities are overall. But I do like the concept of doing it. You are going to be covered by doing that position because you're buying more option contracts than you're selling. And the biggest thing about this is that if the market continues on up, and if you can get it done for a small debit or maybe even a net credit in some instances based on how you construct them, then if the market does go up, which is ideally what you want to do, right? The concept would be I'm buying protection in case of the catastrophic meltdown in this instance. So my idea is that we really want those markets to go up. So has there ever been a better example of where this trade would have worked out than when we hit the March lows because of the pandemic that's going on right now? So then that instance, it definitely would have worked. Now, you got to realize that there's a scenario here that's really bad, in that if I sell this put option and the stock comes down and it goes below my short strike but doesn't get to my long strike, in that instance, you don't want to fall asleep. So if I put this position on, I definitely want to know when it gets below my short strike, because if it goes below my short strike but doesn't get to my long strike, in that scenario there, I might have an obligation to buy some underlying stock. And I want to make sure that if that's the situation, what I'm getting myself into, I want to either close out that position. Maybe I do want to buy some more stock. Actually, it makes it a little bit more interesting if I am willing to buy more stock at that lower price. But it is definitely a more complex trade. Do I think that it works in certain situations? Yeah, definitely. And I have talked about it on Options Playbook Radio, specifically back a couple of years, I think before 20. I like to talk about these type of strategies going into the year end on stocks that I have fairly decent gains on overall.
Well said, Brian. Yeah, I like that approach as well. I think any hardcore look at just buying, let's say, straight up 5% out of the money puts in the S&P to hedge all the time, 3 months out, that approach has a huge drag on your portfolio over time. So it doesn't take a genius to realize maybe you need to find other ways to finance that approach and protect against what, in the case of Talib and his Black Swans, is that catastrophic sell-off. And that's what that put spread will do for you out there. Interesting stuff. Unfortunately, Brian, that music needs to come to the end of our roughly 20-minute sojourn here through the world of Options Playbook Radio. But don't worry, Brian and I like you guys, so we're going to do an extra Huddle episode for you in a little bit. So stay tuned for that coming on your network feeds. But before we go, Brian, if folks are intrigued, they want to join the Question Palooza here on these Huddle episodes, maybe they have a question for you directly in between episodes, where should they go? What should they do?
All right, you can always email me directly at theoptionsguy@invest.ally.com. I want to say thanks for listening. Keep the questions coming in. And as always, we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.